folks, a lot of people are saying it's about to get scary. Halloween, October, it's about to get ugly, folks, okay? A lot of people are saying stocks are going to go down big in October for many various reasons. We're going to have an actual stock market crash that's going to occur in October. So what I want to go through in this video is, do we have the mixture? Do we have the ingredients? Do we have the potion to get a major stock market crash in October? Or is this just a bunch of more of bear hype and excitement from them thinking they're going to get a crash and keep pushing it out, and October is going to be the month, right? We know on seasonality, they have a case. Seasonality many times can be very bad in October, especially in election years. So they have a case there, but we're going to see, do we actually have the ingredients to actually get the stock market to go down substantially in October? And should we be looking at puts? We got one trading day left in September. Should we be looking at put options for this month? Let's get into this. First ingredient, we got a big bad boogeyman, and his name is inflation. Now, this big bad boogeyman, he's kind of been going dormant. He's kind of been going dormant now at this point in time, right? But will the big bad boogeyman of inflation, which is what really caused the stock market to tank in 2022, right? Inflation went so high, the Fed had to raise rates aggressively. It obviously hurt the economy. It certainly hurt a lot of company earnings. A lot of big tech was overhired. They had to fire a lot of folks, and then they got back on the right track starting in 2023 and in 2024, right? But could we have inflation problems that lead to the stock market to, let's say, have a major dip or crash in October? Well, just today we got out some new data here. The PCE price index, a measure the Fed focuses on to measure the cost of goods and services in the U.S. economy, rose 0.1% for the month, putting the 12-month inflation rate at 2.2%. Excluding food and energy, core PCE rose 0.1% in August. That was up about 2.7% from a year ago. The all items inflation gauge was below Wall Street estimates and the lowest since early 2021. This was horrible news for the bears here today. The bears needed this report to come in hot, meaning essentially they needed inflation to be coming in, worse than expected. They needed that. They were hoping for that. They were banking on that. And so the fact that inflation came in tame, that's not good for the bears at all. They needed this to come in hot, because if this came in hot, then that would send basically a signal that the Fed cannot continue to lower rates at 50 basis points. They got to slow the process, right? And that would lead potentially the market to sell off. So a lot of bears were banking that, this report's going to come in really hot. I don't know what they were banking off of other than hope, because there was really nothing you had to bank off of that this was going to come in, this report was going to come in very hot. There was no data that would have shown this is why this report's going to come in super hot. It was just basically a hope and kind of pray approach in regards to the bears, and that's what they did here. And clearly that's certainly not working out here, right? Now, we might want to look further than that. So let's look at commodities. Well, here's the deal. This is GSG. Everybody should track this. If you have any sort of, stock tracker app or whatever on your phone or on your computer, everybody should always keep track of GSG. GSG is going to let you know if you got big inflation problems coming down the line or not really, because this keeps track of overall commodities. Commodities are asleep. This is the past month for commodities, down 2.2%. So we don't have any sort of major commodity inflation that all of a sudden is going to hit in October and everybody's going to say, oh my gosh, this is insane. This is such a problem. So we don't have that. If we look at oil futures, is all of a sudden the price of gasoline going to cause everybody to freak out? No. Look at this. This is on a 1 month basis. The price of oil is down 12%. 12%. This is what we call 6 feet deep, and it's in the coffin at this point in time, right? Could come back to life next year. That is something to be aware of for next year. But in terms of in the short term, in October, gas prices, is that going to be some sort of big issue? Nope, not whatsoever. If we look at Trueflation numbers, which I trust Trueflation numbers more than the government data, but when we look at Trueflation numbers, we're at a CPI right now about 1.5%. In U.S. government numbers recently, which are very backwards looking, are around 2.5%. So inflation's dead, completely dead at this point in time, right? If we think about housing, inventory on housing is going up and up and up. I'm seeing it more and more. I keep track of Phoenix and Las Vegas specifically. I'm seeing inventory go up more. I think these numbers are going to be up even more in September. And if you have more and more inventory coming online, I can tell you that's not going to be great for price increases. So in my opinion, I think we're still kind of setting up for either a deflationary environment when it comes to housing and rents, or very flattish, but we're not set up for like some sort of big skyrocket in the short term in regards to this. 2 years from now, 4 years from now, could be a totally different story. But if we're just thinking about the very short term, we're not setting up for that at all, right? If we look at mortgage rates, we're still insanely high when it comes to mortgage rates. We're still 6% plus, which is insanely high for any time in really the past 15 years. You got to understand, everybody has been programmed for basically the past 15 years to expect a 2.5% to 4.5% mortgage rate. When you're at 6% plus, you're not going to magically make everybody go out there and want to buy homes. And so this is why you could continue to see inventory pile up in the housing market, and why you're set up more likely for a deflationary environment in housing for the next 12 months than inflationary. So if you're thinking about, remember, we're thinking about October specifically, and the stock market crash we're going to have in October, right? Okay, is housing going to be an issue? No, it just doesn't set up to be an issue at all. If inventory was going much lower and we had, if we had mortgage rates at 4.5% right now, I'd say, ooh, man, maybe we get some housing inflation numbers that people aren't too happy with, but we don't have it. So if we think about it, we don't have the ingredients. We do not have the ingredients for inflation to go insane in October and cause some sort of dramatic worry and concern from the market about, oh, inflation's back or inflation's coming back and you better watch out, you better not cry, you better go not buy anything inside. I mean, that's just not realistic, right? So inflation, that boogeyman, he's asleep. Next one up here, earnings season. Earnings season could always be a catalyst to send the market much lower, right? And we do have earnings season. It will be kicking off in guess what month? October. So you could look at earnings season and say, oh boy, that's where our problems will come in. When the earnings start hitting, they're going to be bad. Well, earnings start out with the banks, the big banks. Listen, a lot of these big banks just were at a conference about a month ago. And from what we heard from a lot of these big banks, there's not a lot of scary talk. And so if you're thinking we're going to get some magical, scary talk, some horrible numbers from JP Morgan and Bank of America and Wells Fargo and all these companies, it doesn't look like it yet. Could it happen maybe the following quarter or the following quarter? Sure, that's always, but we're talking about this month. We're talking about October. Are these companies' guidance going to be some horrible guidance numbers that is going to freak the market out big time? Probably not, just to be quite frank. The banks are pretty well in a pretty good position. I think one of the most knowledgeable people that are not a banker, right, but knows the banking space insanely well is a gentleman from The Big Short movie, right, Steve Eisman. He's gone on CNBC several times in the past few months, and I think he knows the banking system way better than I do, or anybody watching this video does, or more than 99.99999% of people out there, right? And Steve Eisman says there's really no issues with the banks. They're not exciting stocks to buy. And he's like, I wouldn't buy them because they're not exciting. But he's like, there's no issues with the banking system whatsoever. They're just going to kind of keep reporting their numbers here in the short term that are going to be just fine. I think, once again, that man is more knowledgeable on the big banks than anybody. And when he comes out and says, there's really nothing going on there, plus you get the confirmation from the big bank CEOs, you got to take it for what it is, right? Doesn't mean there can't be problems a year from now or 2 years from now. But for right now, there's nothing. And so if you're banking that these earnings are going to come in horrible for the banks to start out earnings season, that might end up being a very, very tough bet to take that, right? Then you say, well, what about the other companies? Well, here's the deal. We're not going to get the real companies that really matter for the stock market. Who are they? They're big tech. They're Tesla, they're Microsoft, they're Apple, they're Google, Nvidia, Meta, Amazon, all those sorts of companies, right? And those are all the big dogs that matter. Salesforce, you go down the whole list. Well, here's the deal. We're not really going to get those company earnings until the end of October, going into November, really. From basically the last week in October through November, that's when we'll get a lot of those company numbers. So if you're banking that, big tech's going to send the market lower, which, by the way, big tech numbers should be pretty dang good. So I wouldn't be banking that big tech's going to report some disastrous numbers and guidance. Just be a little careful about that, especially we're in election season. Spending big on Google and Meta, I just would be a little careful about trying to bet heavy against big tech. But even if you did think big tech's going to report trash numbers, we're not going to get those numbers likely in October. We're likely getting them in November or the very end of October, right? So I think it's a tough bet to think earnings are going to destroy the market when we're likely not even going to have the big earnings that you really want until like the end of October, November. And like I said, the only ones that could really tank the market are the big banks. And I just don't know if the big banks' numbers and guidance are really going to be something that's going to be like, oh my gosh, everybody's going to freak out and sell the whole stock market because of bank earnings. It just doesn't look like it's that sort of setup for right now, at least, right? So that's when it comes to earnings. Then you say, well, what about sentiment? Could we have sentiment tank in October? Sentiment's been riding high. We can't deny that. Nearly 50% of stock market participants are bullish on the market for the next 6 months. Very, very bullish. Now, there's two ways we can look at this. One, we can say, well, this is way too bullish. This needs to be more bearish. And so therefore, because we're way over the historical average for bullishness, we're way under the historical average for bearishness here, right? So you could say sentiment needs to come down big time. This is more proof that the market needs to tank, and if we all of a sudden get investors start going the other way, we can get it going fast. Well, yes, but in order to tank sentiment, you've got to have some sort of fundamental problems that really tank sentiment, right? That then can tank the market. So it needs to be like inflation's going high, the Fed's not going to continue to cut rates, or they're going to raise rates, or earnings are super bad, or unemployment's going. You need to have something there. You can't just have sentiment go bad for no reason. It has to be reasons, right? So you could look at it, but you could look at it from that negative angle of like, well, we need to go more bearish, so this is just naturally going to go more bearish. But an additional way we can kind of look at this is, if you're this far bullish, it's going to take you a while to even get investors to start feeling bearish about the market. It is not going to magically happen in a matter of a few weeks. It's going to potentially take months to get folks from the bullish side over to the bearish side, right? And so that's just another thing that you could look at, and it's like it's hard to really see the market going down substantially in October based upon sentiment there, right? Then you say the election. Well, guess what? That could potentially tank sentiment. But that's not till November. So we're not getting those results this month. Or excuse me, not this month. I'm still recording this in September. In October, the month that everybody thinks the market's going to tank, right? We're not getting those results then. We're getting it in November. So this could tank sentiment. I'll be honest with you guys. If the election is too far on one side or the other, what do I mean by that? If one party seizes control too much of the House and the Senate, and let's say, becomes president, the market could go into a big sentiment problem in regards to that. The biggest worry for the market is that Harris would win, and it would kind of be like Dems would just dominate this election, essentially. That would definitely cause the market to, I'm just going to be honest with you guys, have problems in the sentiment. That's not the belief that's what's going to happen, though. There's a belief that things are going to kind of be split up, and you're kind of going to end up in gridlock in Washington, which is actually what the stock market wants. So what stock market wants, big investors want, hedge fund money wants, they want gridlock. So they don't actually care that much who becomes president, whether there's T-Man or H-Woman. So I don't even know if that's a weird thing, but whatever. They don't really care as far as that goes. What they really care about, they want gridlock. And if you listen to a lot of these big Wall Streeters, that's what they're talking about. They want gridlock, and that's what they also expect. But if you didn't get that, then you could talk about sentiment tanking. But once again, we're not getting that in October. So if you're banking on this October stock market crash, that's tough. Could you get a November stock market crash? Yeah. If the election goes one way, people might freak out and sell stocks heavy. But we're not getting that this month, right? Hey, it's Jeremy. I hope you really enjoyed that clip here today. What you looking at in front of you right there? That's the 6-figure Hall of Fame. Do you want to see the next one? That's the 7-figure Hall of Fame. Now, that is my private group. Those are members of my private group that have scaled to 6 figures, multi-6 figures, 7 figures, multi-7 figures in their stock market portfolio. They say you are the average of the 5 people you associate with. If you're somebody that is having trouble finding other long-term investors that are focused on building their wealth over the coming years, finding like-minded folks, look no further than my private group. We got a tremendous amount of people. We're consistently talking with each other, learning from each other, researching companies together, sharing news about our different companies, right? We do all that inside my private group. If you would like to apply to join us in there, go down in the description area. There'll be an application down there. You can click on that and you can apply to join us in there and take your game up to a much higher level and associate with the type of folks that you actually want to associate with. Tom Lee, everybody's favorite bull. Tom Lee went on CNBC actually last night, spoke about his views on where the market's headed from here, what's going to happen in October. Looking forward to hearing his thoughts and reacting to that one.
Contributor live with us once again at Post 9. Nice to see you.
Great to see you, Scott.
Since the Fed did their jumbo cut, the market really hasn't done all that much except for one day last Thursday.
Why do they keep calling it a jumbo cut? Stop it with all that jumbo cut stuff, man. 50 basis points, 75 basis points, then you call it a jumbo. 50? Come on.
Why?
Well, I think the Fed unleashed us on an easing cycle, and that's going to be positive. We know it's actually historically positive 3 months, 6 months out. But what stocks do in the next month is a bit of a coin flip, and I think that's what we're seeing because there's some repositioning that took place. And also we're now thinking about the 40 days into the election.
So does the fact that the election is but 40 days away sort of ruin the perfect scenario for stocks to get that post-Fed bump?
I think it delays it, just because, it says that I've been speaking at and seeing wealth managers and family offices, a lot don't want to commit capital until after election day, and I don't think it matters who wins. It's just they want to get
exactly. That's such a mistake by so many people. They're premeditating this decision about I didn't want to be in stocks, July, August, September, October, but after the election, that's when I'm going to buy. And it's like, okay, what happens if October is usually a bad month for the market? What happens if hypothetically October is a good month for the market as well? And suddenly you're buying S&P 500 at 5,900 or 6,000 or something like that, right? And you just missed out on this monumental amount of gains. And then what happens if after the election happens, like the market goes down? Like you never know. Like that, everybody's banking that, okay, it's good. Market's going to be horrible into the election. Then after the election, it's going to go up like a rocket ship. Like what happens if it's the opposite? And this is something I've been talking about for a while on the channel. Like what happens? Like, and this is why the time of the game. It's so silly. It's such a silly game that all these folks try to play. Oh yeah, the market's going to be bad. And everybody thought September was going to be bad. And gosh, I think September's been pretty good, has it not? Like I can't complain with my gains in September. That's for dang sure. I'm glad I was in the market in September. And now October, everybody's banking. Oh, market, please go down. October, please go down. Please go down. Please go down. What happens if it doesn't? What happens if we're up more? What happens if October's even stronger than September? No one's expecting that. What happens? Like, man.
Event behind that.
Oh, so you think we're going to have sort of a dash to the finish after Election Day is out of the way?
Yeah, and that's pretty typical. In fact, in election years, the November, December rallies are pretty tremendous. And in fact, when markets are up more than 10% in the first half, you also get big rallies November, December, sort of choppy through September.
You think investors are sold on the idea that this economy is going to make it? It's going to make it through. The Fed's going to pull this off. Is any of what we've witnessed since Fed Day doubts?
Before we get into the economy, the big mistake everybody's making is let's call it what it is. Okay, if you're a true investor, you do not care if the stock market goes down in September, October. Oh, it's going to go up in November. It's going to go up in December. You're not playing those games of in and out of the market. If you're an investor, you are. If what? You're a trader. If you're a trader, you care about all this. You're in the market, you're out of the market, you're in your portfolio, you're out of your portfolio. But here's the problem. These same individuals that are supposed to be traders are then making the cardinal sin of stock market trading. What is the cardinal sin of stock market trading? It's assuming certain things are going to play out and making premeditated moves that happen a month, 2 months from now. If you're a true trader in the market, you need to be trading what? The market that's in front of you, not the market that's a month from now or 2 months from now. If you're just making premeditated trading decisions in your head and like, I'm going to do this, what are you trading off of? You're not trading off technicals. You're not trading off fundamentals. You're not trading off anything. Seasonality? Who trades off seasonality? Come on, that's a little silly as far as that goes. Man, can that go south sometimes? So if you're not trading based upon data, fundamentals, technicals, you're gambling straight up. Like trading's already pretty much gambling, but I mean, like if we want to take it further, we can take it further. That's straight up gambling now at this point in time. Saying I'm not going to own the market for these sort of months, but after this month, come on, man, that's straight up gambling. So yeah, silly. The
bigger picture.
So far, so good. This Friday we get core PCE, and hopefully that confirms inflation is no longer on the front burner. But I'd say one thing I've noticed is that the number of investors and professional money managers that think we're already in a recession is very high. And so I think the evidence just has to be better than expected, and I think those views shift back to soft landing.
When we've seen, recently targets for the S&P, Brian Belsky, I keep bringing him up because he's the most recent to raise his target up to the highest now on the street. I've asked you about, the market lately. You haven't sounded like you'd be raising your own target to a degree like that, would you?
I think there is a lot of upside in the foreseeable future. Let's say 3-6 months out. But for someone to tactically say we need to pin a 6,000 target and then put money to work today, I think it's harder to make that case because valuations aren't on the cheaper end, and we've already had a fairly sizable move. So I'm not saying I'm bearish right now, but to me, I'd have a lot more confidence saying 3-6 months out, things are attractive, especially things like margin debt, right? It actually decreased in August, meaning investors have been deleveraging. It hasn't gone anywhere for the last 4 months at a time when markets are rising.
I guess my point would be it would have been better articulated to just say you don't sound as bullish as you usually are. Is that fair?
Yes, I'm bullish into year end, but I'm a little less confident about how markets behave into election day. And not that I think we're going to have a huge drawdown. If we do have a big drawdown, I'd be buying that dip. But I also don't think we can make new highs and then see the market blast off after election day. So I'd rather sort of say things look a lot better after election day.
Can we make new highs if tech doesn't resume its leadership?
Here's the issue, and here's why I really would love the market to be risk on in October, and I love us to blast this thing higher. I mean, part of me really wants the market lower because I can buy for a cheaper rate, but part of me secretly wants the market to go up a bunch in October, just because I would love to see all these individuals who have been on this sideline of market's bad in September, market's bad and going to be bad in October, so we're going to buy after the election. And I would just love to see the market go risk on in October and just blast higher. And I'd love to see what all these individuals do. What do they all do if the market blasts higher in October after it already had a good September, and then are they still going to buy in November? That's my big question. Are they going to FOMO in at some point in October? Let's say the first 2 weeks of October, really good. No one's expecting that, right? Are they going to FOMO in it at that point? Oh my gosh, I'm on the sideline. I got to get in this market. What's going on? These stocks just keep going higher and higher and higher. I so want to see this. And so my secret hope, I hope the market goes up a bunch in October, because man, am I going to look forward to seeing what do all these people do that are all been betting, getting out of the market, banking on this.
In anywhere close to the degree that it had?
As long as tech is a market perform. If tech actually declines, that's going to be hard for the rest of the S&P 500 to compensate. But what we've seen so far, including the days like NVIDIA and Tesla recently, is that tech is actually holding its own, but other stocks are starting to show catalysts and signs of life.
Yeah. What about the broadening trade? I mean, you look at the Russell, your big call, of course. Week to date's down more than 1%. Really hasn't done much at all. I kept hearing, hey, you got to wait till the Fed cuts. Then you go into the Russell. I don't know. What do you think?
Well, Russell had a big week last week. It's some profit taking now. But I think that there's, this is what bottoms look like. I don't think bottoms are straight up. I know in 2021, energy was bottoming, and it was also very choppy, but eventually made not only new highs, but then basically had a blistering gain in 2020, in the year following. So I think that's a multi-year start for the Russell. It feels choppy, but we're still near all-time highs, and there's a big fundamental case to own small caps.
Some have made the case that there are a lot of areas of the market that are overcrowded at this point. So many different sectors have gone up a bunch. You look at industrials and utilities and other things that have traded near or at highs. Therefore, they find better value in bonds. What do you think?
I think a bond investor is buying a bond for a different reason than buying an equity. Because an equity gives you not only inflation protection and benefit from falling yields, but also capital appreciation and positive surprise. Bonds rarely give you positive surprise. I think a bond investor someone should have some income with some capital upside there, but there are so many good opportunities. And, the fact that China has started to actually perform better and potentially broken out, that's again a breadth signal, because that's been a big drag for the last few years.
Oh, how about that? Do you feel like the move that happened in China this week's a game changer on how we should view what, the potential turn in their economy means for the overall markets? I mean, we've seen certain stocks get a nice boost, some of the luxury goods companies, right? LVMH, Estee Lauder, et cetera.
And the gaming stocks.
What about in the bigger picture?
It's hard to tell what's a trading rally versus a bottom for China. I spent some time talking to Mark Newton, our technical strategist. He thinks this is a bona fide breakout, and it is coming on the heels of not only stimulus, but in the face of unrelenting bad news for China. So to me, a rally on bad news is a sign that maybe the worst is already priced into China, and that means it could rally for a while.
All right.